just business news, we're news for business people.
Hello and welcome. You're watching Trend Spotting on Bloomberg Quint Live, and I'm Navneet Saluja D'Souza.
Hi, I'm Agam Akil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and its implications for investors. But first, the headlines. Markets continue to hunt for direction as Nifty slips near the 10,150 mark. Metal stocks drag the street while PSU banks extend support. And oil marketing companies are back in the green after leading the losers charts on Tuesday. And Indiabulls Housing Finance falls over 2% after it sells 10% stake in the UK-based Oakworth Bank. And Sun Pharma is one of the top Nifty losers after the management says that it cannot provide a timeline for the resolution in its Halol facility.
All right, let's take a look as to how the markets are trading at the moment. Well, nothing has changed from the opening session. Nifty is still about trading in the red. In fact, we are hovering around the 10,150 mark. Remember, today's level to be watched out on the downside will be the 50-day moving average on Nifty, which is somewhere around 10,115. So watch out for that level. Well, clearly, Bank Nifty has been outperforming. It has been trading in that tight band of 250 points in the last 5 sessions, and it has managed to actually hold above the 25,200 mark, which is the first crucial support for Bank Nifty. The market breadth today is in favor of the declines. Clearly, if you could just pull up the graph of NSE stats, that will give you a clear picture. It's almost 1:2, telling you that there is selling which has come in the broader markets as well today. That's the Nifty 50 on your screen. In fact, what is outperforming, we've already highlighted Bank Nifty is doing well, but pull up the Nifty PSU Banking Index. That's been trading in the positive territory. We've seen positive reaction coming in for Bank of Baroda. The bank declared its quarterly earnings post-market hours yesterday, and it has reacted positively, where we did see asset quality improving on sequential basis. Well, in terms of Nifty gainers, you've got the oil marketing companies, which are doing well after a bit of blip was seen for the international crude oil prices. BPCL, HPCL are your top Nifty gainers. Also, IOC is trading in the green, and Ambuja Cement has seen good gains of almost over 1%. So a couple of your IT stocks, TCS and Tech Mahindra, are trading in the positive territory. On the losing side, your top loser today is Hindalco, down about 2.5%, and Sun Pharma too reacting to its numbers, which were pretty much in line. That's seen a cut of about 2.5%. ONGC, Vedanta are a couple of other losers in today's session. Nagam, what's happening on the broader market side?
Well, largely evenly poised between the broader markets in terms of the gainers and the losers. But let me begin with two securities which are gaining. Religare Enterprises as well as Fortis Healthcare. Each of these stocks are gaining well over 9 to 10% in today's day of trade. Navneet may have mentioned Biocon to a certain extent, and Balakrishna Industries as well, along with TVS Sri Chakra. Of course, a whole host of these tire stocks have gained substantially in today's day of trade on account of the big changes that we are looking at when it comes to tire prices. Videocon Industries also up as much as 5%, and we have gains coming in Inox Winds as well, along with Minda Industries moving up by as much as 4%. In terms of losers, and there is some weakness as well in the broader markets, well, I would like to highlight stocks such as, I think I have a stock here in terms of weakness, but if we can pull up some other losers in the broader markets out there, you'll notice that there has been some amount of weakness in a lot of the other counters, such as, can we have some losers there, because I do have this thing stuck.
Okay, Agam, you know what? I was observing the crude price, the rubber prices on Shanghai have seen a bit of correction, on back of which we've seen a positive move coming in for a lot of these tire makers. If you could just pull up the chart of MRF, Apollo Tyres, Balakrishna, they've seen good gains, in fact, coming about in today's session. So clearly, that's the space which is outperforming today. You've got the likes of MRF, Apollo Tyres, as well as Balakrishna Industries, which have seen positive gains. All right, let's move ahead on Trend Spotting today. We discuss the trends and fluctuation in the volatility index. We put the spotlight on what is making footwear players lose grip, as we connect with Avinash Gorakshakar of Joindre Capital, and we also connect with the management of Dixon Technologies to decode its stellar September quarter numbers.
Well, but first up in the special segment in Bloomberg Edge, where we have Jayesh Khilnani, who tells us about a pattern on the Bloomberg terminal that is thrown up, and it's a very interesting pattern too. It's something that Navneet and I have been discussing on and off on the F&O show. But Jayesh, I'm going to let you take us through the new pattern that's emerged when it comes to volatility.
Thanks for that, Agam. So I'm watching out for two charts, that is the Nifty Index and the India Wix Index, which measures the volatility that, the fluctuation that the traders are expecting going forward in the next 30 odd days. Now, the India Wix has actually, surged above the level of 14 for the first time in, since August 2017. Let's have a look at the chart that we have on the screen and see how the Nifty and the India Wix have an inverse correlation. That is, so this is the chart. The bottom panel shows you the India Volatility Index, and the top panel, the green line, is the Nifty Index, which is trading close to the 10,150 mark. Just go back sometime, in August, we had seen that the Wix had actually surged above the 14 mark. And what did the Nifty do at that point in time? It made a low of about 9685. And post that, you saw that the Wix actually came off from the high, and the Nifty rallied from about 9,600, 9,700 odd levels right up to 9,800, 900 levels. Move forward a little bit in the month of September. The Wix again, managed to briefly touch the 14 mark, and the similar pattern was seen. Nifty made a low of about 9687, which was also similar to the one that we saw in the month of August. From there on, we had a non-stop rally on the Nifty till about 10,400 lifetime high levels that we saw on the Nifty. So what's interesting is currently it is trading above the 14 mark. So, and we have seen that the Nifty has declined for about 7 odd sessions. So, the reading into this is that are we looking at a market bottom formation, and we can see a rally in the coming days.
Right. What may also be a matter of concern is that the corrections that we've seen after the Wix has moved up to the mark of 14 have been reasonably deep. That said, in terms of the kind of corrections that we've seen over the last couple of years, there's only been twice that we've seen corrections of deeper than 10 to 11%. This is after we have seen, some amount of volatility. So we will be watching out for that, and that's very crucial as to what Jayesh is pointing out, because the mark of 14, not just Jayesh, but also a lot of the other analysts and experts have also been pointing out, is very crucial. And should we see the Wix move up to the level of 14.5, there could be an issue.
In fact, yesterday's high was 14.7. It receded from those levels.
Right.
If you could just pull up the intraday chart of India Wix, I think we opened below the mark of 14. It was hovering somewhere around 13.3 or 4, but there has been an intraday recovery. There you go. It's almost just about trading flat, once again back above the mark of 14. And clearly, as Jayesh was highlighting, Agam, it's pretty interesting. The last time India Wix surged to levels of 14 was in the month of August or September, somewhere around 22nd August, when the markets corrected from highs of 10,150. We are back to those levels.
Right.
And last time around at these levels, there was some supply seen around the 10,150 mark, and after that Nifty actually slipped to mark of 9,700 or 9,750. So this is a crucial support actually where Nifty is trading right now. If there is more supply, there could further be some bit of selling pressure, but if as Jayesh was mentioning, if this is a bottom, probably we can see once again some bit of buying coming at these lower levels, but that remains to be seen, because India Wix has once again corrected and is firmly trading above the mark of 14.
Right. Well, there you have it, guys. We will be watching out for the India Wix, and well, of course, considering the fact that the Nifty itself, not only technically but also fundamentally, as a lot of experts out there are suggesting, that these are stretched valuations. So we will be watching out for that. These are precarious times. But that's how we move on to the first trend of our day. Footwear stocks. The footwear sector has been under the spotlight, with Khadim making his debut in the secondary markets yesterday. However, the players are trading under pressure, and what is weighing down on the sector, and is there a bounce back in sight? But to answer this question, give us more insight, joining us on the phone line is Avinash Gorakshakar, the head of research at Joindre Capital. Hi, Avinash. I always wanted to bring the fact that, all these footwear stocks, which are categorized as mid-caps, a lot of them are trading at valuations of over 40 times, and this is not FY17 but FY18. That's price to earnings. Then in comparison to the rest of the broader markets and perhaps the footwear stocks in an absolute basis, do you feel that they are overvalued? Because we are looking at a little bit of correction, though we don't know if this is going to be long lasting or no.
Yeah, I think Agam, you're right. I think ahead of the Khadim IPO listing, there was a lot of action in all these footwear stocks, especially stocks like Bata, Mirza, tanneries, and typically I think Liberty shoes. But I think you're right that the kind of numbers which have come out in Q2 clearly reflects that GST impact has definitely come. And that is definitely, impacting most of the stock prices. So I would believe that, in terms of overall top line growth, in terms of margin improvement, maybe a couple of quarters, the business could remain challenging. And only beyond FY18, that is FY19, one could see a strong recovery in top line as well as margin.
Well, it goes without saying, Avinash, these footwear stocks are trading at expensive valuation, considering how the other, stocks from the consumption theme usually trade at those expensive valuation. But you talked about GST impact being reflected in the earnings. This is one sector where majority of the market is actually with the unorganized market. Now, with GST coming into play, there could be a bit of shift from unorganized to organized, which could lead to market share increase for these organized players. What sort of impact do you see with regard to increase in market share in the coming quarters, and which particular company do you think will be the biggest beneficiary of this?
I think clearly, Navneet, this is a valid point. I think a large portion of the production, in this sector comes from the unorganized players. But typically, I think, for the GST impact to get normalized, I think it would take a couple of quarters. And I think, obviously, FY19 could be a better year to actually, correctly point out whether GST impact has actually resulted in some market shift coming from the unorganized to the organized sector. And here, I think a bigger player like Bata, which is actually present across all the price points from the mass market to the premium markets segment, I think could definitely be a beneficiary. Although their Q2 numbers were slightly not very encouraging, the top line was more or less stagnant. I believe that FY19 could be a lot better for Bata, considering the fact that they have a very low leveraged balance sheet, they have a significant geographical presence, and a very strong product bouquet. I think Bata definitely looks a lot better. Any correction should be used as a good opportunity to actually accumulate the stock, because FY19 could be a definitely better year as compared to the current year.
Okay, and so in terms of growth prospects, I do want to peg Bata as against its other listed players like Liberty or Relaxo or Khadim for that matter. But, considering Avinash has just spoken about Bata's second quarter numbers, and he has alluded to there has been very lackluster growth, because we've just seen about a near 1.5–2% growth on a year-on-year basis for the second quarter. But what has also stood out in the second quarter is that there's been a margin expansion, and consequently profits have also seen some amount of growth. So based on that, Avinash, if you just quickly tell us about why have we seen that margins expansion, and whether or not this is here to stay specifically for Bata.
No, I think my guess is margin expansion obviously has come in from a little bit of softness in raw material prices, and I think clearly at the operating EBITDA level, the markets and most of the analysts would get a positive feel on the stock once the top line growth gets back into double digits. I would believe that this raw material cost push may not happen subsequent quarters. It may remain soft for a quarter or two. But I think going forward, any re-rating in the stock could happen only when the top line actually shows a strong double-digit growth. So definitely margin improvement is welcome. But margin improvement coming in the absence of a very muted kind of top line growth is definitely not something most of the analysts or the markets would like. So I think overall these margins may maintain, but any incremental upside to these margins looks limited.
Avinash, majority of these players, including Bata, they've been focusing more on premiumization. In fact, I think even Khadim mentioned in their offer document that they are looking at brands which are on the premium side. But do you see there's a fear of losing out in terms of volume growth for these companies if they focus on premiumization?
I think clearly there is a market which is willing to pay a significant premium for premium footwear, and I think Bata primarily earlier was focusing on the middle and the lower segments. So I think clearly as a strategy, I think Bata definitely is looking to penetrate the premium segment quite aggressively, and to some extent I would believe that yes, the impact of that strategy would be reflected in FY19, because FY18 even the second half is going to be extremely challenging. The kind of headwinds we see on the existing business are pretty, challenging. So that would obviously play off in FY19. And yes, as you said, India is a mass market with various kind of customers, but premium markets possibly would grow in mid-teens to double-digit growth over only a period of say 12 to 18 months. So in the near term, this premium strategy may not work out very well for players like Bata. But yes, over the longer term, I think margin expansion and top line growth could definitely kick in.
Okay, so for the benefit of our viewers, now I want to pull up the table in which we have pegged all the valuations together for the 3 or 4 stocks. So, you have, if you put Khadim, Relaxo and Bata together in terms of your FY18 price to earnings, you will see that Khadim is at around 40 times, Relaxo is at 50 times, and Bata is at around 48 times. So in this case, Relaxo is more expensive. And when it comes to the market cap to FY17 sales as well, it is in tandem with Bata at around nearly 4.1 times, as against Khadim at just at 2.1 times. But why is it that Relaxo is looking at steeper valuations in comparison to some of its peers? So then let's pull up the next plate in terms of the growth trends that we've seen over, say, FY17, FY18, or rather, so in terms of revenue growth or for that matter net profit. There you have it. So over the past few years, and this is FY13 through 17 CAGR, again, Relaxo stands out in terms of growth as against Khadim or Bata, around that from 15%. Again, in terms of profitability, Khadim has seen better profitability CAGR over this period of 4 years. But when it comes to margins, again, Relaxo beats the other two guys at around 11% as against 8% for Khadim and 8.6% for Bata. Coming down to return ratios now, this is again where Relaxo stands out. And in terms of return on equity, Relaxo is a tick. Return on capital, Relaxo is a tick at around 27%, and again, return on assets around 12%. So Avinash, now I want to come to you on your preference and the priority. What we've realized is that while Relaxo has seen better fundamentals and in return ratios as against Bata and Khadim, it is also more expensive. So based on the prospects of the entire industry, how would you peg these 3 or 4 players in terms of preference going forward?
I think, Agam, I would believe that, I think Bata as well as Relaxo definitely have a very strong potential. But I think in terms of numbers, Relaxo definitely stands out. If you look at the return on equity, return on capital employed, and the top line CAGR, no doubt Relaxo has done comparatively better than Bata in the last 3 to 4 years. And I think this is primarily because, their cost control management is much better. The base effect has also played out for Relaxo. So I would believe that, yes, if somebody has a slightly higher risk appetite, one could definitely look at Relaxo if one were to take the next 2 years. But Bata being more broad-based, I would categorize that even Bata could definitely benefit from the consumption story, from the GST impact. So to that extent, I think I would put my bets, in a balanced way on both Relaxo as well as Bata. I mean, keeping a preference on Relaxo because margin improvement as well as the return ratios could definitely keep getting better over the next couple of years. But definitely Khadim is the new player. I think it's just listed, and as you mentioned, they have shown good EBITDA margins, but how they do maintain these margins post the IPO, I think that would be a key factor to watch out, because only after a couple of quarters one could get a reasonable idea of how the earnings trajectory for Khadim would pan out.
All right, Avinash, we leave it at that note. Thanks a lot for joining us and giving us your views on the footwear space. Some bit of correction seen for Bata after its earnings yesterday. Clearly, majority of these brands have been, focusing on premiumization. And as Avinash mentioned, it's going to take a couple of quarters for shift in market share because they are the beneficiary of GST from unorganized to organized market. Let's move on to the next trend. Dixon Technologies has reported a strong set of numbers for the September quarter, with profits seeing a jump of 33%. The company's margins were highly aided by its ODM business, and Somit Sarkar tracks the counter pretty closely. Somit Sarkar was in conversation with the head of strategy and planning at Dixon Tech, Saurabh Gupta. Listen in.
Dixon Technologies' revenue and net profit were up around 33% and 19% compared to last year. Is this because of the festive season that played out in the second quarter?
Yeah, generally the festive season also has an impact. Quarter 2 is generally a best quarter for us among all the 4 quarters. The festive season is definitely there, but also we are seeing a good traction in all our segments. especially the lighting segments, where we have been able to add more customers. We have been able to add 3 big customers in this financial year, which is Crompton, Panasonic, Anchor and Wipro. And we have a huge order book from them. And if you see overall the lighting segment, the revenues are up by almost 72%. And there has been expansion in margins also. The margins have expanded from 5.1 to 6.9%. And the overall, the LED, the consumer electronic business also continues to reflect strong continuing performance year on year. There has been a growth of 75% in our Q2 revenues. So basically, of course, the Diwali season has some impact on it, but of course we are seeing an overall growth in all the verticals, as the penetration levels in all these verticals are still very low in India. The washing machine, the penetration level is just 6 to 7%. The LED, the penetration level is just 11 to 12%.
So the order book that you mentioned that you have received from the new customers, can you give us a bit more detail about this order book? Like what is the size of the order book? What is the execution period?
Yeah, I would just like to mention that Philips still contributes a significant portion of our revenues in the lighting segment. They still contribute 80-85%. So the business of Crompton Greaves has just started. The contribution is still very small, but we have a huge order book from both Wipro and Crompton Greaves. So we think the growth in the lighting segment will continue to be there, and you'll see the margins to be maintained in that segment as well as what we achieved in Q2. I won't be able to share any specific numbers on. I won't be able to share any specific numbers on a particular client, but the only thing which I can mention is that the order book is quite strong, both in lighting and the washing machine segment.
Your mobile business shows a sharp fall compared to last year, but on the margin front there was an expansion. Like, what were the reasons behind this? What was the reason behind a 50% drop in the revenue?
Yeah, so one of our existing customers, so there are some short-term challenges. One of our existing customers, his sales has actually dropped in the mobile business, maybe because of the competition from some of the Chinese players. But we are in active and deep discussions with one of the bigger companies in India, with some of the bigger companies to add more customers in this segment. And you will see a significant rebound in revenues and profitability starting Q4. We think India is a huge opportunity in the mobile market. India will be, in the next 3 years, India will emerge as one of the largest mobile phone markets, smartphone market in India. And with the whole policies of the government on mobile phones, where they have levied a 10% duty on import, and also as part of the phased manufacturing program, government may introduce duty on the motherboards and PCBs as well, which will ultimately drive the growth of mobile phone manufacturing and mobile phone assembly in India.
The drop that you mentioned related to one player, is it just related to one player, or is it an industry trend that is going on when it comes to mobile phones?
No, it's a trend across only one player, which is kind of struggling. But we expect to add more customers, and you will see you will see a strong growth in revenues and profitability from Q4.
How do you plan to scale up your reverse logistics business? Because that segment has been a drag on your books as of now.
Yeah, you are absolutely right. See, reverse logistics, there were three major businesses in that: repair and refurbishment of your set-top boxes, LED TVs, and mobile phones. Now there are challenges in the set-top box businesses. That is not growing because of saturation in the set-top boxes. The whole pace of digitization has slowed in India. But there is a huge potential in both mobile and LED TV as a category. And we think we are taking some time to ramp up our capacity utilization in both these verticals. And I think so there will be a significant rebound in starting Q4 in these revenues. The opportunity is huge, and we think the business is quite scalable, both in mobile as well as LED TV. We don't expect the set-top boxes business to grow going forward, but there's a huge opportunity in both mobiles and LED TVs.
The ODM segment is generally the most profitable segment for you, but your revenues from ODM was a bit off in the second quarter when you compare to the financial year 2017. So how do you plan to improve increase your focus when it comes to ODM segment?
Yeah, so if you see vertical wise in the lighting segment, our ODM revenues has actually increased from 30% to 42%. So there is an increase of 12% in the first half of the year as against same period last year. In the consumer electronic business, the ODM business has actually come down from 12.5% to almost 6.5%. So there has been a good 600 bips drop in ODM business. But we expect the H2 to be significantly better as far as ODM revenues are concerned. So H2, the ODM revenue share should actually move into lower double digit, and gradually by next financial year, we expect almost mid double digit revenues coming from ODM business in a consumer electronic, which will ultimately lead to margin expansion and ultimately lead to the return on capital employed expansion.
By how much basis points do you expect your margins to expand by shift from this OEM to ODM?
I don't want to put a number to it, but if we continue to deliver good numbers on ODM in all our verticals, I think so. The margins can expand by 50 to 60 bips every year.
Out of the IPO proceeds, 22 crore was used to repay debt. But if you see on a gross basis, your debt has still increased by 79%. What led to such increase?
Yeah, see, as you mentioned, because if you look at the debt, basically the long-term debt has remained the same at around 10 odd crores, but the short-term debt has actually shot up from 33 crores to 66 crores. And this is mainly on account of the increased working capital requirements and the increased sales in the lighting business. Also, there was some temporary disruption on account of GST in the month of June, where our cash flows had suffered. So we had to fund that cash flows. So basically the short-term working capital requirements, which has really gone up. But if you look at the next 6 months, these numbers would keep coming down. And the long-term debt is just 10 crores in the overall debt.
All right, that was the management of Dixon Technologies. But before we wrap the show, if you could just pull up the intraday chart of the Nifty Mid Cap Index, there has been a bit of recovery that has been seen. There you go. That's the intraday chart. There has been buying which has emerged at the lower levels. In fact, we have seen the advanced decline also improving just a bit. Start of the show, it was 1:2, and currently it's about 3:5 again.
I'm really curious if this is institutional buying or retail guys buying into the mid cap stocks, but we're going to have to wait and watch on that one. But with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money. Stay tuned into Bloomberg Edge.